Good morning, everyone, and thank you all for joining in for this session. Firstly, let me introduce myself. My name is Tarang Solani, and I'll be the host for this session on F&O strategy. F&O strategy is a very smart way to participate in any kind of in market swings which we have been seeing in the market. So, what we'll be covering in this session is firstly, we'll give you the F&O, we'll give you an insights on various F&O strategy in different market condition, be it bullish, bearish, being it range bound or volatile, because futures and options is the only segment wherein we can trade in all the market direction, and how we can take advantage of that. Let us understand in our further slides for this. So before starting with this session, can anyone reply on the chat box? Is my voice audible to you all, and is my screen visible? Or you can also reply on the question answer section, which is there on the right hand side of your screen. Is my voice audible to you all, and is my screen visible properly? Can anyone please reply? Okay, can we get more reply? Please refresh everyone. Screen is not visible. I am getting. Is my screen visible now? Yeah. So my screen is also visible. Correct? Yeah. Okay. Thank you. So as I told, what we'll be covering in this session would be few insights on the futures and options strategy, how we can take advantage on different market conditions, and also we'll start off with options first, basics of options, because to understand the option trading strategy, we need to understand the basics of options. I'm sure majority of the participants who will be attending this must have some kind of a basic knowledge, but this will also give you a boost to your knowledge once you understand about basics of options, because it is quite necessary to understand first basics, and then we'll go to the next part of complex option trading strategies. So let us understand about options. So as you will be aware, there are two types of options. One is call option and the second one is put option. Now, take advantage of bullish view, one need to buy call option. So if the particular stock or index goes up, the price of the options will also go up, thereby benefiting you. And if you have a bearish view on the market, that means that you feel that the market will go down. So in this scenario, you need to buy put option. So if the particular market trends lower, or it goes down, the price of the put option will increase, and thereby benefiting you if you are a buyer of a put option. The same thing, you can also take advantage by selling call option if you have a bearish view. So two things which you can do if you have a bearish view: either you can buy put option or you can sell call option. And to take advantage of your bullish view, there also you can do two things: either you can buy call option or you can sell put option. So this is how we need to first understand. This is a very basic in a layman language which we have provided you the snapshot of it, how we can buy and sell call option and put option, in which scenario I will be benefiting if I am a buyer of a call option or a seller of a call option, and same thing for put. So if you are a buy, if you have a bullish view, two thing you can do it: either you can buy call option to take advantage of your bullish view, or you can sell put option. And same way, if you have a bearish view, couple of things you can do it: either you can buy put option or you can sell call option. So in which scenario, what you can do and how much capital is required for buying and selling, both requires different capital. So that we'll understand in a different slide. Now, suppose I have a bullish view on the market. So I have a bullish view, two things I can do, that is I can buy call option and simultaneously I can sell put option also to take advantage of my bullish view. So here I have taken an example of buying of call option. I have a bullish view on the market, and I am buying 17,500 call option at 150 rupees. Now, whenever you are a buyer of an option, your capital is very low. Requirement of capital is very low to buy this 17,500 call option at 150. So this 17,500 is called as the strike price, and 150 is called as the premium. So if you're a buyer of an option, your investment here, you are buying one lot of Nifty, that means 50 shares, and 150 rupees. And so 150 rupees into 50, there's 7,500 rupees you are paying to buy 17,500 call option, 150 rupees. So only 7,500. Sorry, only 7,500 amount is required to buy the 17,500 call option. Now here, the capital requirement is very low if you are a buyer of an option, being it call or being it put, and your maximum risk also limited to the capital which you have put to buy 17,500 call up. That is 7,500 is only your maximum risk. If in case your view goes wrong here in this scenario, you are expecting the market will go above 17,500 levels. So if in case market doesn't go above 17,500 levels and it closes below 17,500, your loss is restricted to 7,500. And in per share, 150 rupees per share is the loss maximum you will be getting it if in case Nifty closes on or below 17,500. But if Nifty starts moving above 17,500, your profit is unlimited if you're a buyer of an option. And that's the beauty of it. In very less amount of capital, you can earn a good amount of returns. So here in this scenario, if you see the payoff chart and payoff table, if in case market starts moving above 17,500, that is 17,800, 900 level, your profit potential is unlimited. But if market closes on or below 17,500 level, your loss is restricted to 150 rupees per share and not more than that. So here, suppose if Nifty closes at 17,900 level on this expiry, you can make 250 rupees per share as a profit on an investment of 150 rupees. That is around 1.5 times of your returns which you can make. So how 250? The difference between 17,900 and 17,500 is 400 points, and you have already paid 150 rupees to buy this. So net net you will be getting it 250 rupees if Nifty closes at 17,900 on the expiry day, and you still hold on to your position. So 250 rupees per share is the maximum profit you can generate on an investment of 150 rupees. So that is around 2.5 times of the return which you can make. Now same thing, let's understand the example of selling of call option. Now suppose I have told that if you have a bearish view, you can take advantage of your bearish view in two things. Either you can buy put option or you can sell call option. So here I have a scenario that I have a view that Nifty at any cost won't go above 18,000 level. That means I'm bearish above 18,000 level. So I am selling one lot of Nifty 18,000 call option at rupees 100. So in this scenario, if I am bearish above 18,000, that I don't feel that Nifty won't cross above 18,000 level, I am bearish above 18,000 level. So that's why I'm selling one lot of Nifty 18,000 call option at 100 rupees. Now here, if you are a seller of an option, your capital requirement increases substantially, because the risk and the reward functionality will just get reversed of what is for buying of options. So here, if you are a seller of an option, your risk is unlimited if your view goes wrong. That means if Nifty starts moving above 18,000 levels, that means your view went wrong, and your risk in this case is unlimited. But if in case Nifty closes on or below 18,000 levels, your reward is just limited to the premium which you are receiving it. This is in this case 100 rupees per share. So here, if you are selling 18,000 call option, 18,000 being a strike price, which we call as a strike price, and you will receive 100 rupees as a premium. If you are a seller of an option, here you will receive this premium, and whatever premium you receive, that is only your maximum profit. If in case your view goes right, that is Nifty closes on or below 18,000 level. But if Nifty starts moving above 18,000 level, that means your view went wrong, and you tend to make unlimited loss. So hence, to subside those are unlimited loss, your margin requirement, that is the capital requirement to sell this one lot of 18,000 call option at 100 rupees, which also higher. Now in this case, around 80,000 or 90,000 rupees of margin will be required if you sell 18,000 call option at 100 rupees. So that is how the margin requirement, and the maximum profit you will be getting it is 100 rupees per share into 50 shares of, if you are selling one lot, that means 5,000 rupees is the only maximum profit you will be making it if Nifty expires on or below 18,000 level. But if Nifty starts moving above 18,000 level, then the loss is unlimited. Now suppose if Nifty closes at 18,300, you tend to make 200 rupees per share as a loss, which is quite huge, because how this 200 came, the difference between 18,000 and 18,300 is 300 points. So it went 300 points against you, and what you have received in this journey is 100 rupees. So 300 minus 100 is 200 rupees, the net loss you will be making it if Nifty closes at 18,200, 18,300 on the expiry day, and you still hold on to your position. Of course, anytime in the between, if you feel that you're not comfortable of holding the position, anytime before expiry, you can square off your positions. There is no as such rule that should hold on to this option only till the expiry day. You can square off. Anytime you can square off your positions after initiating any transaction. So there is nothing as such hard and fast rule for that. So now let us understand about put option. So put option, as I made you understand, if you have a bearish view, you can buy put option to take advantage of the bearish view. So suppose if the market goes down, prices of the put option will increase and that by benefiting you. And the second way, you can look put option as an for the investor perspective. That is, put option is like an insurance policy for any kind of an big portfolio holders, or if anyone has big positions in MTF or futures, they can use put option as an insurance policy. So how? Let us understand. Now, suppose you must have got vehicle insurance with you. So in that vehicle insurance, once you buy any kind of a vehicle insurance, you pay premium to that insurance company to buy vehicle insurance. So here also, if you buy put option, you pay premium against that. And once you buy an insurance, vehicle insurance, the insurance company will assure you that if anything happens to your vehicle, if it gets stolen or if it gets if anything happens, if it gets stolen or if anything happens to your vehicle, like any kind of damages, then this insurance company will compensate you. So same thing, you are buying a put option. That put option is an insurance to you. Suppose you are buying 17,000 put option. That 17,000 put option of Nifty is an assurance to you to how much ever Nifty goes below 17,000 level, I will compensate to you. So this is how we can relate put option as not only as in for the trader who have a negative view, you can take advantage of it by buying put option, but also as an investor who are having big positions in MTF like e-margin instrument or in futures position, or they have a big portfolio, they can safeguard their portfolio by buying put option. So if in case the market goes down, the portfolio value will go down, but put option will help you to compensate some of the losses which is incurred from the value which is going down in the portfolio or big holdings which we are having. Because here also in like insurance, if in the particular year, if you buy an insurance, if nothing happens to your vehicle, then the premium will go and your vehicle has been saved. So same thing here, if you are buying put option, you are paying a premium. If in case Nifty doesn't go, suppose you are buying 17,000 put option and Nifty doesn't go below 17,000 level, that means your premium will go and as a loss. So there is because your portfolio will be saved and you will get benefit in your portfolio, but there won't be anything profit which will be getting it from the premium which you have paid. So this is how the insurance company and the put option works. I mean, it's very much similar to each other. However, they can be safeguarded for the different asset classes. So yeah, the example of put option. So if you are a buyer, suppose you buy 17,000 put option at 80 rupees. So here I have a view that I have a negative view on the market. I have a view that Nifty will go below 17,000 level. I have a negative view. So in this scenario, I can do two things. Either I can buy put option or I can sell call option. So here I am buying put option. I have a view that Nifty will go below 17,000 levels. So in this scenario, I'm buying 17,000 put option at 80 rupees. So here, if I'm a buyer of an option, so my risk is just limited to the premium I am paying it. That is 80 rupees per share, and that is only my capital investment. 80 rupees into 50 shares is one lot of Nifty. That is 4,000 is only my investment. If in case my view goes wrong, I will be losing not more than 4,000 rupees. But if my view goes right and Nifty starts moving below 17,000 level, I will make unlimited profit. So here in this scenario, in this payoff table, you will be able to understand if Nifty closes on or above 17,000 level, you will lose only 80 rupees per share, not more than that. But if Nifty starts moving below 17,000 level, now suppose Nifty closes at 16,700, then you will be getting 220 rupees per share as a profit on an investment of 80 rupees per share. That is approximately three times of your investment you can make profit. So how 220? Difference between 17,000 and 16,700 is 300 points, and you have already paid 80 rupees while buying a 17,000 put option. So 220 rupees the net will be making it if Nifty expires at 16,700 levels. So this is the beauty of buying of option. Your risk is limited, your capital is also the capital requirement is also very less, and your reward is unlimited if your view goes right. Now here, selling, I will take an example of selling a put option. So as I made you understand in my first slide of options, that if you have a bullish view, you can take advantage of bullish view by buying call option or selling put option. So here I have a view that Nifty won't go below 16,800 levels at any cost, because there is a multiple support. Suppose I have a view that Nifty has a multiple support of 16,800 and it won't go below 16,800 levels. So what I do is I sell one lot of Nifty 16,800 put option. That means I am bullish above 16,800 levels. So I will sell one lot of Nifty 16,800 put option at 50 rupees. Now I'm a seller of an option. So if a seller of an option, your risk is unlimited. If in case your view goes wrong and Nifty starts move up below 16,800 levels, you tend to make unlimited loss. But if Nifty starts moving above 16,800 levels, then your profit is capped at 50 rupees per share. And if it closes above 16,800, how much ever level it closes above 16,800 levels, your profit is capped at 50 rupees per share, and you won't get more than 50 rupees per share as a profit. So here in the payoff table, you will be able to understand if Nifty closes on or above 16,800 level, one will get 50 rupees per share as profit and not more than that. But if Nifty starts moving below 16,800, suppose it closes 16,600 level, one will lose 150 rupees per share if Nifty closes 16,600 level. How 150? 16,800 minus 16,600 is 200 points, and you have already received 50 rupees while selling 16,800 put option. So net 150 rupees you will be losing it. So that was all about options. Now we'll understand about a few of the option trading strategies. So as our main agenda for this webinar was to make you understand about different option trading strategies, as is a very smarter way to participate in market swings. So let us understand on the option trading strategies for different market direction. First, we'll take a direction of bullish strategy. If you have a bullish view, what kind of an option trading strategy you can do. So if you have a bullish strategy, you can do a bull call spread strategy. Now, what is bull call spread? If you expect an up move in the market and want to reduce the cost, in this scenario, you can initiate bull call spread. Now, how to use this strategy? You can buy one at the money call option and simultaneously sell one out of the money call option to reduce the cost of the same expiry. Time frame would be, if you are doing this strategy for a monthly expiry options, your time frame should be 7 to 14 days for the options to be, for the strategy to be profitable. Exit rules for the strategy is, one, if you're playing for an event, once the event is over, you should exit the strategy, or if you reach a predefined level. Now what is predefined level? In this case, whatever option you sell, that is the out of the money option, what you sell, if Nifty or if any of the stock which you're selling, if the stock or index reaches that level, that level is a predefined level where you should ideally exit this strategy. And if you have still got a positive view, you can initiate one more strategy for the higher strike prices. So this is the narration of bull call spread. Now let us understand with an example. Suppose I have a bullish view on the market. I feel the market will go up above 18,000 level for the Nifty. Current market price for, suppose it is 17,500. So what I will do is I can I have a two things I can do is either I can buy call option, or I can do some kind of a strategy where I can reduce my cost of buying call option. So here what I have done is I've done a bull call spread by buying 17,500 call option at 200 rupees, and to reduce the cost I have also sold 18,000 call option where I will be receiving premium of 120 rupees. So net now from my house I have just paid 80 rupees per share, and that is only my maximum loss if in case my view goes wrong. Unlike if I'm just buyer of a option that is 17,500 call option, if my view went wrong, I would lose full 200 rupees. But to safeguard this, I've hedged my position by selling 18,000 call option to reduce my cost. I've sold at 120. I've received premium of 120, and net I will be from my house at only 80 rupees per share is gone. So if in case Nifty closes on or below 17,500 level, I won't lose more than 80 rupees per share. But however, I've restricted my loss. My profit have also got restricted above 18,000 levels. I won't incur any incremental profit. So here my break even for this strategy is 17,580, because 17,500 is a call option I have bought and 80 rupees is my cost. So net net I have to add cost from my buying strike price. So above 17,580 I will start making profit. My maximum profit for this strategy is 420 rupees per share. That is, if Nifty expires on or above 18,000 level, I will make 420 rupees per share as a profit. But if Nifty expires below 17,500 level, I will lose not more than 80 rupees per share. That is my maximum loss. So here with the payoff diagram, you will be able to understand that if Nifty expires on or below 17,500 levels, I won't lose more than 80 rupees per share on the expiry if I still hold on to this position on the expiry day. But if Nifty starts moving above 17,500 level, suppose it closes at 17,900 level, I will make 320 rupees per share. At 17,800 level, I will make 420 rupees, which is the maximum profit, and above that I won't make any kind of an incremental profit because I've capped my profit by selling the option. So this is a beauty if you want to reduce the cost in this volatile market, rather than going for a naked call or put. You should always hedge your position by selling some options to receive the premium, so that your overall risk reduces if in case your view goes wrong. However, your profit will also be capped, but it is always important to reduce your risk, because profit, if your view goes right, you will incur a profit in both the ways. Either you go for a plain vanilla options, which we call as a long call or long put, or you go for any kind of an hedging strategy. In both the direction you will get a profit, but main important thing is how you can reduce your risk if your view goes wrong, how you can minimize your loss. And this is the way where you can minimize your loss by doing this kind of a strategy. Another view which we'll be talk about is a bearish strategy. We had already spoken about bullish strategy, how you can take advantage of your bullish strategy. That means if you have a positive view on the particular stock or index. Now, if you have a negative view on a particular stock or index, how you can take advantage of it. So we have a strategy for that is a bear put spread. Now it is similar to bull call spread, but now we have been doing the same strategy with put option. So when to initiate, again expect a down move in the market and want to reduce the cost. At that point of time, we can do this bear put spread strategy. How to use this strategy is buy one at the money put option and simultaneously sell one out of the money put option of the same expiry. Time frame should be 7 to 14 days. If you are doing for a monthly expiry options, you should hold on for 7 to 14 days for this strategy to be profitable. Exit rules for the strategy is once the event is over or once we reach a predefined level. So here the predefined level will be the option which you have sold, the put option. If that level reaches, then you should book profit in the strategy. Or if your view is still there, negative view still persists, you can again initiate the different strategy of the lower strike prices. So here we have taken an example. Suppose Nifty is floating at 17,500 level. I have a view that the Nifty will go down. So I can eitherly go for put option of 17,500 at 180 rupees. Now, if my view goes wrong, I will lose full 180 rupees as a premium. But to safeguard, now I am also selling 17,000 put option, which is and slightly out of the money put option at 80 rupees. So net net now from my house only 100 rupees would be the loss. If in case if my view went wrong and Nifty starts moving above 17,500 level, so I will make only 100 rupees per share as a loss. Unlike if I am just buying put option, I would have make 180 rupees per share as a loss if my view went wrong. But here I am hedging my option by selling 17,000 put option. So I'm receiving a premium of 80 rupees. So my cost have reduced from 180 to 100 rupees. So break even for this strategy is 17,400. Below 17,400, I will start making a profit. How 17,400 to 17,500 is the strike price which I have bought, and 100 rupees is the cost involved in it. So 17,500 minus 100 is 17,400 is the break even point, and below that I will make profit. Here also similar to, since I have sold this 17,000 put option, I have restricted my loss. I have restricted my profit into it. So maximum profit for this strategy is 400 rupees. So difference between 17,000 and 17,400 is the break even. That is 400 rupees is the maximum profit I will be making it, and maximum loss for the strategy is 100 rupees and not more than that. If in case Nifty starts moving above 17,500 level, I won't make a loss of more than 100 rupees per share. So this is the payoff diagram, wherein your maximum loss is 400 rupee. Sorry, maximum loss is 100 rupees. So sorry, it is written as 80 rupees, and maximum profit is 400 rupees if Nifty closes on or below 17,000 levels. Now, one more strategy. Suppose I have a view on the market that will see a very big movement in either direction. I don't know in which direction the market will show the movement, but I am sure that in either of the direction market goes, but it will show a big movement. So whenever we see a big breakdown in of a big support, if the big support of a stock is breached, then we do see a very big fall in that direction of that particular stock or index, or that particular stock or index do take a support at this level, or we do see a very big upside. So whenever there is and the same thing we can illustrate while the market is on the resistance level, or a particular stock or index at a resistance level. Either do see a resistance getting breached, and the stock or index do show a very huge movement on either direction, or if the resistance has been taken, or it will show the negative movement if the resistance is persist. So in this kind of in this kind of a scenario, we have a strategy called as long straddle, wherein you don't have to aim where the market will go, but you just have to find out the event, which we call as event, wherein will the particular stock or index will show a big movement in either direction, and that by benefiting you. So long straddle strategy is a delta neutral or market neutral strategy. That means whose profitability does not depend on the market direction. So long straddle is perhaps the simplest market neutral strategy to implement. Once implemented, the PNL is not affected by the direction in which the market moves. The market can move in any direction, but it should show big move in that direction. As long as the market moves, a positive PNL is generated. So rules of entry and exit. When to create this strategy? This strategy can be created on intraday or positional basis in weekly and monthly options. Ideal strategy if one expects spikes in implied volatility in the near future. Whenever the implied volatility increases, we do see that the option premiums also increases significantly and becomes expensive. So if we have a view that the implied volatility will increase in near future, at that point of time, the strategy would be profitable. Can be created during any important event when IVs are very low and big movement is expected. Very effective in Nifty and Bank Nifty on day of weekly or monthly expiry, where usually big movement is seen in both the indices on that day. So you must have seen on the weekly and monthly expiry, the premiums are very low on the expiry day, weekly and monthly expiry day. That is last Thursday of every week. The premiums are very low for that particular expiry for Nifty and Bank Nifty, and usually market do see very big movement in either direction. So if we if we do this long straddle strategy, wherein we just have to aim for a big movement in either direction, if that happens, your strategy will be profitable and you will make profit from the strategy. Now, what are the exit rules for this strategy? Is keep a stop loss. Always play this strategy with a stop loss of 10 to 20% of the total premium outflow. Book profit if the total premium increases by 20 to 30 percentage. And also in the third scenario is implied volatility falls, then despite index showing sharp movement, the premiums won't go up that much, and it is better to exit the strategy. Now let us understand with an example. Suppose Nifty is at 17,500 levels, and I feel that in the coming trading sessions, Nifty will show big movement in either direction, but in which direction I'm not sure. So long straddle strategy, how you can do this long straddle strategy is by buying at the money call and at the money put of the same strike price and the same expiry. This is how you can make long straddle. So here Nifty is at 17,500 call option. I want to initiate long straddle, so I'm buying 17,500 call option at 150, and simultaneously I'm buying 17,500 put option at 150. The total net premium I'll be paying is 270 rupees. Now, one thing I have to make sure that from current level, Nifty should show more than 270 points movement in either direction, either on the upside or on the downside, for my strategy to be profitable. So here my break even is 17,230, 17,500 minus 270 is 17,230. Below 17,230, my profit is unlimited. And on the upper side, 17,500 plus 270, 17,770, my profit is unlimited. If Nifty starts move above 17,770 levels, my profit will be unlimited. So maximum loss for this strategy is 270 rupees. If Nifty expires at 17,500 levels only, that means if it don't go, if it doesn't go anywhere, if it expires at 17,500 only, I will lose full 270 rupees per share as a loss. But if Nifty starts moving above 17,770, that is upper break-even point or lower break-even point of 17,230, my profit is unlimited. How much ever it goes below and above that break-even point. So this is the payoff chart. As I made you understand, if Nifty stays in the range of 17,200 to 17,800, I will make loss, and maximum loss is at 17,500 of 270 rupees per share. But if Nifty starts going below the lower break-even point of 17,220, 230, then I will make unlimited profit. If it expires at 16,800, I will make 430 rupees per share as a profit. And same way on the higher side, if it starts moving above 17,770, I will make unlimited profit. Suppose it expires at 18,000 level, I will make 230 rupees per share as a profit. So this is the beauty of long straddle. You just have to time the big movement in the market, and doesn't have to time in which way the market will go. Whatever way the market will go, you should be sure that the market should go above the premium which you have paid. It should show a movement more than the premium which you have paid to buy this long straddle. And here, as I made you understand, you should play this strategy with a stop loss and target. The stop loss is 10 to 20 percentage of the total premium outflow. So in this case, you have paid 270 rupees, which is the total premium outflow. You should keep a stop loss of around 50 to 60 rupees. If this premium reduces from 270 to 210 rupees, you should exit this strategy. And same way, your target should be 20 to 30 percentage of the total premium. So if this premium of 270 rupees increases by 100 rupees or 120 rupees, that is around 370 or 390, if it reaches, you should book profit from this strategy and doesn't wait for the further movement. So now second last strategy is, we have a view. Suppose market doesn't go anywhere, neither bullish nor bearish, neither we have a view that the market will show a big movement. And the fourth view, we have the market will show a range bound movement, and which we have been seeing in the last few months. So after breaching some level, now market goes into a range bound movement. And in this scenario, how we can benefit from it? So we have a strategy called a short straddle strategy. So it's a complete opposite of long straddle. Sorry. So short straddle strategy is opposite of long straddle, can be created when there is a range bound movement expected in stock or index. Very effective in low volatile stocks. We have a low volatile stocks like ITC, Coal India. They are very low volatile stocks, and they usually basically uh, show any kind of a movement into the market. They are very much range. They show very much range bound movement. So this kind of strategy is very useful for this kind of stock, low volatile stock. So how to use this strategy? Sell one at the money call option, and simultaneously of the same strike price, sell one at the money put option and of the same expiry. What is the exit rules? Keep a stop loss if in case your of 20 to 25% of the total premium inflow, if it goes above, you should keep a stop loss, and you should book profit if the total premium decreases by 40 to 45 percentage. So here I have a view I've taken an example of Bank Nifty. I have a view that the Bank Nifty will show a range bound movement. So what I do is I sell Bank Nifty call option and put option of the same strike price and the same expiry. So suppose Bank Nifty is at 40,000 levels. So I will sell 40,000 call option at 500 rupees, and I will receive 500 rupees as a premium because I'm a seller of a option. And I will also sell Bank Nifty 40,000 put option at 400 rupees. So net net I will receive 900 rupees as a premium. So my break even point is 40,000 minus 900 is 39,100, and 40,000 plus 900 is 40,900. So if Bank Nifty expires between this level, lower break even point and upper break even point, I will make some kind of a profit, because I have a view it will see a range bound movement. And if Bank Nifty expires between this level of lower break even and upper break even point, then I will make some kind of a profit in this strategy. But if Bank Nifty starts moving above this level, or below this lower break even point, or above this upper break even point, then my loss is unlimited. So in this scenario, my maximum loss is unlimited if Bank Nifty expires below 39,100 or above 40,900 level, because I'm a seller of an option. However, my maximum profit is 900 rupees per share if Bank Nifty expires at dot 40,000 level on the expiry day, and I still hold on to this strategy. And my losses, sorry, my profit is maximum is 900 rupees if Bank Nifty expires at dot 40,000 levels, because at this level your premium of 40,000 call and 40,000 put both will become zero on the expiry day, and you have sold this, you have received this 900 rupees as a premium, and thereby you will benefit if Bank Nifty expires dot at 40,000 level. So this is a payoff chart. If Bank Nifty expires between the break-even points which we have mentioned, you will make some kind of a profit in this strategy. But if it starts falling, or if it starts moving above and below the break-even point, then your loss is unlimited. Now, one more and the last strategy which we will be discussing is about hedging strategy. It's a very good strategy. I think we should all make use of this strategy in this kind of a volatile scenario. And this strategy will be very much helpful if you are a trader in futures, if you're a trader in e-margin kind of in stock like MTF. Also, if you have a big portfolio with you consisting of a good amount of stocks, then this strategy is very much helpful. You can use this strategy to safeguard your loss and safeguard your stocks if in case there is an adverse movement. So there is an hedging strategy called as protective put strategy. So what is protective put or put hedge strategy? Is a hedging strategy where the holder of a security buys a put option to safeguard against a drop in the stock price of that security. Suppose you are holding any kind of a big quantity of stocks of ICICI Bank, and you simultaneously buy a put option of it. So this strategy will help you if in case your ICICI Bank stock falls, then this put option will safeguard you for that, and hence your loss will be restricted. Now, when to create this strategy, a protective put strategy is usually employed when the trader is bullish on a stock but wary of uncertainties in the near term. It is used as a means of protection. So let us understand with an example. Now, suppose you have a bullish view on ICICI Bank, but also simultaneously you are wary of uncertainties which will happen into the market. If in case there will be, then the ICICI Bank will take a beating and it will show some kind of a negative movement. And thereby, if you are holding in future or stock, that will lose you a lot. But simultaneously, if you safeguard your position by buying put option, your loss will be restricted. So here I have bought one future of ICICI Bank either in derivatives, or I have bought in e-margin big quantity of ICICI Bank at 830 rupees, and simultaneously I am buying ICICI put option of 830 strike price at 15 rupees to safeguard if in case ICICI Bank starts moving low, I will gain from put option. Put option will benefit me, and thereby it will help me to reduce my loss. So here my break even for this ICICI Bank, if I do this strategy, so it is 830 with the future I've bought, and 15 rupees I've paid as a cost to hedge my position. So 830 plus 15 is 845 is your break even point. Above 845 level, you will start making profit, which is unlimited. How much ever ICICI Bank goes above 845 level. So maximum loss for this strategy is 15 rupees per share, not more than that. If ICICI Bank expires, if ICICI Bank expires below 830 rupees, you won't lose more than 15 rupees per share, how much ever it goes below 830 rupees, because you have 830 put option with you, which will safeguard you of your future positions which you have. and hence 15 rupees is the cost which you have incurred for buying 830 put option. That is only your maximum loss if ICICI Bank expires how much ever below 830 levels. The profit is unlimited if ICICI Bank expires above 845 or above. So same thing, you can do it for protective call strategy. If you have a short positions in future and want to safeguard your short positions, you can buy call option to hedge. So yeah, this is the payoff diagram. If ICICI Bank expires on or below 830 levels, your loss is 15 rupees per share, not more than that. But if ICICI Bank starts moving above 845, which is your break-even point, the profit is unlimited. Suppose ICICI Bank expires at 900 rupees, you will tend to make 55 rupees per share as a profit. If you hold on to your position on the expiry day and it goes to 900 rupees. So this is the beauty of protective put strategy. And in this kind of a volatile scenario, it is always advisable to do this kind of a strategy to safeguard your position into the market and to hold on to your positions without any stress. With this kind of a strategy, you can use this tool to hedge your position. So there will be a double benefit for this if you hedge this position in futures. If you are a futures trader, then if you simultaneously buy put option, you will see there are two benefits. Your margin requirement would also reduce significantly because there is a hedging leg which you have created. And the second thing, of course, your loss will also be restricted. So you will get two benefits. Your margin requirement will also decrease if you are buying futures positions and simultaneously you are buying put option of the same expiry to safeguard your position. Your margin requirement will decrease significantly by 50 percentage, and also you will also be hedged in terms of the stocks shows movement against you. So your loss is also restricted. Now let us understand about different HDFC Securities offerings, because while trading in derivatives market, we understand that you should have a very low brokerage, because trading in derivatives market requires easy entry and exit and quick entry and exit, due to which your cost of entry of exit should be lower, so that we have a flat rupees 20 per order brokerage plan for all our HDFC Securities clients. If you don't have this brokerage, you can avail by subscribing to a derivative value plan, which is only worth of 199 plus tax, which is an annual charges. Approx 232 rupees will be charged, and in 1 year you can take benefit of rupees 20 per order. And not only that, if you subscribe this derivative value plan, you will also get free access to Pro Terminal, which is our advanced trading portal, which is a very good tool for analyzing to take a trade in any kind of in positions. If you are doing any technical analysis or derivative analysis, this Pro Terminal will help you to do any kind of an analyze and help you to pick the trade. So you will get a free access to Pro Terminal, which is worth of 1,999. If you subscribe to this derivative value plan of 199 only, you will get rupees 20 per order brokerage in F&O and also free access to Pro Terminal. So make sure once you subscribe to this, you should have a derivative privilege with you, because only after having a derivative privilege, yeah, this plan would be applicable to you, and then only this benefit will be transferred. But if you don't have derivative privilege is the online registration of derivatives trading. You can do it on the online. You can basically register your to trade in derivatives market. It will take a T+2 days to do this registration process. And once you are registered to trade in derivatives, you can offer derivative value plan of rupees 20 per order, and also free access to Pro Terminal of rupees 199 is the total cost of derivative value plan plus tax. So only after getting a derivative privilege, opt for derivative value plan. One more main advantage of trading in derivatives with HDFC Securities is you get a zero interest on derivatives margin on the collateral shares. So if you want to trade in derivatives and you don't have extra funds with you, you have a big portfolio of 10, 15, 50, 1 crores of portfolio. So what you can do is you can pledge some of your shares from your portfolio. Against that, whatever margin you will be receiving by us, that is called as a collateral margin, you can use that margin to trade in derivatives market without any interest cost. Our competitors do charge with this facility, but they do they do charge an interest for that of around 18 percentage per annum. So if you take this position with the collateral margin and you hold on for 1 month, you pay 1500 rupees per around interest charges with them. But with us, we don't charge any interest cost. It's a zero interest component. And if you hold how much ever time you want to hold, you can hold on to your position without any interest cost, which saves your interest component. So you can use your portfolio productive. You can also use this a margin to trade in various strategies. You could trade in buying of or selling futures. You can also use this margin to sell options, because options, as I made you understand, if you are a seller of an option, the margin requirement is quite high, and if you want to take benefit of it, you can use the collateral margin, and against that you can sell the options, making your portfolio productive, and you can earn an income from it. So it's a very good tool. You can take advantage of it. If I'm not sure, none of the competitors do provide this kind of a facility. You can use this facility to trade in derivatives market without any interest cost. And these are the benefits of Pro Terminal, which I made you understand. To subscribe for derivative value plan, you will get a benefit of a free Pro Terminal access, which has 15 minutes build up, advanced charting, research screeners, equity gainers and losers, and radar, and many more things. So that's it from our end. I hope this webinar was quite useful to you to understand about options, option trading strategies, various strategies which you can use in different market conditions. This will help you to take your trade at next level. I hope it is quite useful to you. We'll also now open this forum for a question answer session. Also, we request everyone to provide us the feedback on this webinar. How did you find, and what kind of an improvement which we can do, and what kind of an webinar you want for any different subjects is. So we'll request everyone to provide the feedback to in the question answer section, and also provide any kind of questions if you have. We'll try to answer all of your questions. So one question which we have received, can one buy put for hedge rather than sell call? Yeah, of course. So, Mr. Jacob, so this was a question which you have asked earlier. I think your answers would already been answered in my presentation. So you can hedge your position by buying put option, as I made you understand while explaining you protective put strategy. It's a very nice way to hedge your position by buying put option rather than selling call option. Yeah, and one more thing. So in the bullish view, one can buy call option in place of selling put. You can do it. One more thing by Mr. Samarth is asking, while hedging for ICICI, isn't it simpler to sell a future if we are already long with stocks? So what you will get in this, sir, if you see the payoff, if you sell the future, if you have stocks in your cash market, suppose you have 1000 stocks in the cash market segment, uh, and you sell a future of 1000 quantity only. So what will happen, how much ever it goes in the future in the lower side, your future will make loss. And same thing, your cash will also basically, if you sell this future, this future will make profit of, suppose it goes by 100 rupees, ICICI Bank falls down by 100 rupees, your future will make a profit of 100 into 1000, that is around 10,000 rupees. And if your stock will make a loss of 10,000 rupees, so net you won't make anything if you sell future against your stocks. But yeah, if you buy put option, you must be knowing, to buy put option your premium is, you need to pay only a sufficient amount of premium. If in case your view, that means a particular ICICI Bank doesn't falls, so you will only have a risk of losing that premium amount, but your portfolio will increase. But if it falls, you will take a benefit of all the, how much ever it goes below, you can take benefit of it, and thereby restricting your losses. So Mr. Vidyanand is asking what you mean by zero interest on derivative margin. So as I made you understand, it is basically if you pledge your shares against that whatever margin you will receive after pledging your shares in the from your portfolio, you can use that margin in derivatives market without any interest cost. So that is called as zero interest on derivative margin on collateral shares used against collateral shares. So one more question by Sadashiv Dandekar is: can you demonstrate on HDFC Securities platform with example how to execute bull call spread? Yes, surely we'll demonstrate it very quickly. So I'll just log in into my HDFC Securities platform. So firstly, I will make you understand about the margin calculator. How much margin, if you want to check, if you do any kind of a strategy, how much margin is required to do any kind of a strategy. If I want to check that, then how you can do it. So go to products, click on margin. So firstly, you have to go to hdfcsec.com website. This is the website. Once you go into this website, go to products, click on margin calculator. Now suppose you want to do a bull call spread strategy. Select the strike price you want to buy and sell. So suppose I want to buy 17500 call and of 29th March expiry 17500 call. I want to buy and simultaneously I want to sell 18,000 call option of the same expiry. I'll click on sell, I'll click on add, and I click on submit. So I will come to know how much margin requirement is 17,000, and you need to add 17,100 plus 2,300 is a total premium which you have paid for buying this 17,500 put option call option. Sorry. So 2,300 plus 17,100 is approximately 17,000, 19,400 rupees of margin will be required if you want to buy 17,500 call option and sell 18,000 call option simultaneously. So now how to you have two ways to do that. Firstly, you can directly buy and sell from here. You need to click on buy, log in with your credentials, and you can buy this option. And simultaneously, once you buy, you can sell this option. You buy clicking on this, and when clicking and after log in with your credentials. So firstly, you have to make sure that if you want to take this margin benefit, which is there of 40,500, because you are doing this hedging strategy, you will get 40,500 margin benefit. So if you want to do this, if you want to take this benefit, you first have to initiate a buy leg and then initiate a sell leg to take this benefit. But if you first initiate a sell leg and then buy leg, you won't get this benefit basically while executing the trade. Post executing the trade, you will get this benefit. After that, your funds will get released. But if you want to take benefit before executing your trade, you have to first initiate a buy leg and then sell leg. So this is how you can do it. And if you want to do a second option to log in into the website, so what you can do, you can log in into your website and you can do it individually. First buy 17,500 call option and then sell 18,000 call option. So it's a two individual leg which you need to do. That also I will make you understand. So firstly, I'll add both the strike price. Nifty 17,500, sorry, and 18,000 call option. So here it is 18,000 call option and 17,500 call option. So I will buy first, click on plus. I can buy how many quantity I want to. I can also buy at market price. I'll click on market. I'll place this order since right now the market is closed. I won't be. And after that, I need to sell this order by clicking on sell. So it's as simple as buying an individual leg. Here you need to buy two individual leg rather than one individual leg. So it's as simple as that. So now we'll take more questions. Mr. Soumitra is asking, where do we get this recorded session? You will get this recorded session. We'll try to upload this on YouTube. You will get this recorded session on YouTube. I will ask my colleague to upload the same, and you can refer to it on the on our YouTube channel. Actually, it's on YouTube Live only, so you can check if it is already uploaded. You can check our HDFC Securities channel in YouTube for this webinar. You can check the recorded. It is already uploaded. Thank you, Mr. Samat, for the appreciation. Sushil Kumar is asking, please throw some light on strangle strategy. So, what kind of in light? So, strangle strategy is basically it's similar to straddle. Straddle, what we do is we buy same strike price call and put, or we sell same strike price call and put. In strangle, we buy and sell slightly out of the money call and out of the money put option. Here, your premium requirement would be lower. If you are a buyer, basically your premium outflow would be lower, and if you are a seller, you will receive very less premium. However, if you are buying for a long strangle strategy, that means you are basically you are basically aiming for a big movement in the market. Compared to straddle, strangle needs a larger movement to be profitable. So strangle, basically, if you are doing for a long strangle, that means it will basically require a larger movement compared to straddle to be profitable. If you are going for a short strangle, it will require some opposite of it. It will require a small range bound movement to be profitable. Compared to straddle, it will require you will get a large movement, a large range for you to be profitable. So this is something the strangle is strangle in short. If I want to rationalize, it's similar to straddle, but your straddle requires at the money of the same strike price call input, and strangle is an out of the money call and out of the money put. So Sashi is asking, Mr. Sashi Kumar is asking, can you please tell about hedging options for for e margin? So you can take this as an example of e margin only, Sashi, which I have made you understand of ICICI Bank. Now suppose you have 1,000 shares of ICICI Bank in e margin at 830 rupees. To safeguard, you can buy 830 put option at 15 rupees of 1,000 shares. So this is a similar example which you can consider for e margin, and all the risk payoff remains the same. However, this is for that particular expiry of the put option will be opened for that particular expiry. If you hold on to this position of e margin after the expiry, you need to buy one more put option because this will get expire, and hence you need to basically buy one more put option of the different expiry to again safeguard your position. So, Mr. Vidyanath is asking, is zero interest on derivative margin feature unique to HDFC? Yeah, it's unique. None of it, best of my knowledge, none of it provides this kind of a facility. This is a very unique, and if any of the broker do provide this kind of a facility, then they take an upfront 50% as a cash margin, and 50% as a collateral margin to take any position of your derivatives to take position in derivatives. But here we allow you to avail all the 100 percentage of the margin which is required in derivatives. You can use that by collateral margin. So this is a very unique facility and you can take advantage of it. Mr. Soumitra is asking, giving us a feedback, the charting platform needs updation like inclusion of OCC, central pivot. So we'll request Soumitra if you can provide your feedback to our customer service team. They will in turn give us the feedback, or else you can write a mail to your respective RM. They will provide us with the feedback, and we'll try to consider how much it can in the near term. Lantika is asking. Latika is asking, is it possible to show how to place hedging orders in volatile market? So right now the market is not open, will not be able to give you a demo for it. It's a very simple tool. Basically, there is no rocket science involved in it. So if you want to place any kind of an volatile hedging, first, suppose if you are buying ICICI Bank, you need to buy this ICICI Bank futures or stock or emerging, whatever you want to buy, in which segment you want to buy, and simultaneously you need to buy put option of ICICI Bank. So it's a two-leg strategy. You need to place two different orders individually. So after that, you can place this hedging strategy. So, Mr. Dr. Devi Prasad Mishra is asking, what is at the money and out of the money options? Sir, it's basically the type of the options. At the money, out of the money, it's a basic of it. We request to refer to our recordings of basics of futures and options. Once you do that, you will get an insights of what is at the money and out of the money options. Mr. Soumitra is asking, where do we get all the recorded webinar? Soumitra, you can refer to the YouTube. Under YouTube, you can go to HDFC Securities channel, and in that you will be able to see all our recorded webinar. Mr. Devi Prasad is asking, how can I determine the strike price in the bearish and bullish situation? So basically, firstly, if you are a bearish or bullish, you first have to either, if you are bearish, you need to buy put option. If you are bullish, you need to buy call option. You have to be sure for that. So firstly, you have to zero down what option you need to buy. Once you zero down your options to buy, to select a strike price, it is always recommended to select the strike price which is near the current market price. So whatever strike price is near the current market price, you can take positions into it. Mr. Balamurli Krishnan is asking, 40,000 margin benefit means that 17,000 plus 3,000 is included in that, or I can add 40,000 to my. 17,000 plus 3,000 is not included in that. So it is over and above margin benefit which we'll be getting is 40,000. So total margin will be required is 40,000 plus 17,000 plus 3,000. So approximately it will be 60,000 rupees of margin will have been required. Mr. Vidyanand Bapar is asking, can we place the basket orders for both the legs together? Yes, we can place the basket orders for both the legs. So how? I will just demonstrate you. So you can go to this. This is our HDFC Securities web-based portal and trade or empowered. Under equity, there is a basket order. So here, if you want to create any kind of in baskets, select derivatives. Whatever basket you want to create, I want to buy 17,500 and sell 18,000 call option. So I will make a basket for it. Sorry. So I will add this and simultaneously, sorry, at what price I want to buy for say 48 rupees. I want to add this and simultaneously I want to sell 18,000 call option 29 March. I'll click on sell. So here it is the current market price. At what price I want to sell? I want to sell at 5 rupees. Market order as of now is not allowed, hence limit order will only be there. So you need to place the orders because I'm placing it lower than the current market price in case of selling and higher than the current market price in place of buying. I'll have to save this basket and I'll have to place the order basket. So once I select both this leg, I can place this order and this order will get executed provided you have margin with you in your balance. So if you have a total margin in your balance, then only your order will get executed. If you want to take a margin benefit, which I already showed of 40,000, which you will be getting it, then first you need to initiate a buy leg, place order, get a first buy leg, and then once a buy leg is initiated, initiate a sell leg. So you can do this. So this is how you can place it from a basket order. I hope this clarifies your question. Latika is asking how to place stop loss and target simultaneously. In options, it is not available how to place stop loss and target simultaneously in a one single order, which is called as a bracket order. In options, it is not available as of now. Mr. Shashikant is asking an example you shown for buying first and selling immediately. After how much money you should have in your account? So if you do this buying first and selling this, so we have shown that how much margin will be required. So for this strategy, around 20,000 rupees of margin will be required if you want to do this by buying 17,500 call and 18,000 sell. So if you buy 17,500 and then 18,000 call option, only 20,000 margin if you have this strategy you can execute. But if you sell first 18,000, you will be charged around 60,000 rupees of margin, and then if you buy 17,500, additional 40,000 of margin, which was the benefit margin, which will get released after buying 17,500 call option. So if you don't want to do this, you can first buy 17,500 and then sell 18,000 call option. You can do this transaction with 20,000 rupees of margin. Mr. Duraswamy Sullivan is asking how to use collateral margin. So there is nothing as such you need to fill any kind of in forms or anything. If you pledge any kind of in shares, and once you take any kind of in transactions in derivatives market, first thing by default, our system will take margin from the collateral margin, whatever you have. And if there is any kind of in shortfall from that, then only will pull margin from the bank account. So it's a very smooth process in the system. You don't have to do anything. Firstly, we'll take a margin from the collateral margin if you have, and this is the system which we have made, and hence your cash margin will not get blocked unless and until you have a sufficient collateral margin. If you don't have, then only your cash margin will get blocked. Uh, um, Sorry, we have already answered a lot of questions, so we are short of time. So we'll conclude this session. I'm sorry if I not answered most of the questions. So we'll conclude this session, and we'll surely make that in our future webinars. We'll answer all of your questions. So thank you all for attending this session. I thank you all, and with a good participation, you attend this session. I hope this was quite useful to you to understand. So I thank you all for attending, and have a nice trading journey ahead in derivatives. Thank you. Yeah.